Welcome back. Topsy-turvy day in the market, but it's a good time to focus on some very interesting research that Motilal Oswal has put together. And to discuss that, we have with us the Head of Research, Gautam Duggad. Gautam, thank you for joining in. Hopefully you are at home and staying safe and working from home. Now, your note on potential buyback candidates really caught my eye, because I think everybody's trying to figure out if, how companies are going to deploy cash, whether they'll conserve it or whether they'll spend it on a dividend or on a buyback. Did you come up with some names, or what is the likelihood in which sectors or what kind of companies that might give cash to shareholders?
Sure. So what we have done essentially is we've ran a framework as to which kind of companies can actually indulge in buybacks. We obviously have to remain cognizant of the fact that there are two events at play. One is the markets themselves have corrected 30%, and valuations have also corrected a whole lot for many companies. Some are at 5-year lows, some 10, and I think some even at 15, 16-year lows. So there is a reasonable probability of companies going for buyback. Some of the buyback announcements we've already seen in the last 1.5 months. So what we have done is we have looked at a couple of operational parameters, companies which have low leverage, good net cash to market cap, indicating some sort of a value in the current market caps. Companies which have always paid out high payouts in terms of dividend, and how much discount is prevailing as of now on trailing valuations. So as you would have expected, the sectors which are falling into this buckets are the usual suspects, the companies and sectors which have inherently high cash generation capabilities and which has been demonstrated amply in the last many years. So sectors which basically come out on this parameters are consumer, technology, some of the auto names which are flush with cash. We've also ran a screen actually just to look at the earnings yield and cash yield. So we have taken a threshold of 6.5% and then filtered companies where the earnings and cash yield is more than 6.5%. Again, the familiar names come in that screen as well: consumer, utilities, auto, technology, and some of the oil and gas names as well. We also have to understand the fact that these are times where a lot of companies would want to preserve cash and conserve liquidity, given that you have no clue when this environment will ease, how long this lockdown will continue. And there are sectors where in the period of lockdown, the revenue itself will collapse to almost zero. So therefore, the companies would obviously want to, err on the side of caution and preserve cash and not necessarily go for buyback. What we have attempted is an exercise to basically filter down some names where, theoretically speaking, or from a conceptual point of view, the possibility of buyback can be high.
Okay, so Gautam, good afternoon. Give us some 4 or 5 names, and do you think that is a good enough? Trigger, or do you think these stocks have some added triggers as well in terms of basic business fundamentals still being intact? Just 3-4 names.
Anuj, what happens in such times is there are multiple factors at play. The basic business model is getting reshaped in such times. So buyback is just one lens through which you look at there are many other problems which are ongoing. So where I find comfort right now is companies in the IT and auto space which are flush with cash. So for example, some of the large cap auto names like Maruti, Bajaj, Eicher are sitting on a lot of cash. The cash as a percentage of market cap, if you look, for someone like Maruti is now approaching almost 30%. Bajaj Auto again close to 30%. Eicher Motors 22%. ITC is close to 10%. So the other names where the cash as a percentage of market cap is quite high is a name in cement like Ambuja Cement, where the cash as a percentage of market cap is now 16%. Then ACC, Castrol, these are names where the cash metric as a percentage of market cap is quite high. When you look at earnings yield and cash yield, and we've taken 6.5% as a benchmark, assuming that's the 10-year G-Sec yield. There again, IT names dominate. Companies like HCL Tech, Wipro, Coal India. Then you again find Bajaj Auto, which features in that filter. ACC features in that filter. Astral again makes a mark in that filter. Some of the names we have already announced the buyback. Sun Pharma, Imami, Dalmia, a lot of such names which have already taken advantage of the lower prices and announced buyback. And what triggered this exercise was I was just looking at some of the data points in US. If you see in US itself for a decade between 2009 to 19, and you just take S&P 500 as a exercise, you will find that over the last 10 years, roughly 5.3 trillion of buybacks have happened in that index. And this is over and above the 3.5 trillion dividends. So we are essentially talking about close to $9 trillion being returned to the shareholders in the form of either cash buyback or dividends. And obviously in that period, we have seen how the market cap of S&P 500 went up from close to 10 to $27 trillion before obviously correcting in the last 2 months. So now those are the couple of sectors and couple of names, but I must also, at the cost of repeating myself, say that this is just one parameter to look at. There are obviously more important things unfolding on the ground.
Okay, take your point. Yes, Gautam, and while the companies might be very cash rich, the names that you've given, the question is, what do they want to do with that money? Do they still want to conserve it given the environment? So that's a caveat worth mentioning. My quick last short question to you is this. Now, your analysis also tells us that 33 Nifty stocks are trading below their 5-year low valuations. 23 Nifty stocks are below the 10-year valuation low, and 14 Nifty stocks are actually below the 15-year low in terms of valuations. In fact, Hindalco, Tata Steel, Power Grid, NTPC, they're at lifetime low valuations. Given that there has been a fire sale out there, just leave us with maybe one or two of your picks, value picks, where obviously prices declined, but there's also business opportunity. So it perhaps makes for a good call.
Hi, Surabhi. See, my thought process is I've been more biased towards growth and quality rather than pure value. So, even in the last conversation that we've had on your channel, I've said that the sectors which I prefer are consumer, technology, large private banks. Those are some of the sectors. If I have to choose something from the value space, I would right now be tempted to look at some of the auto names because, again, on a trailing basis, their valuations are trading at roughly 30 to 40% discount on a 5-year average. If you see just price to earning, 30 to 45% rather. So those are some of the names in large cap auto names. We prefer Maruti, Eicher. Consumer, our preference has been there forever for Hindustan Lever, Pidilite, Britannia, Titan. In technology, we like both the large caps, Infosys, HCL Tech. Pharma, again, while there are not many large caps left, but off late it has seen some bounce back. Sun is something which we like in that space along with Lupin. And of course, in financials, while there has been a massive damage and there is a lot of uncertainty still in front of us for the next 6 months, I think some of these large caps like HDFC Bank or ICICI Bank, Kotak Bank, Axis Bank, they've corrected a whole lot. They may keep correcting a little more. We have no clue where it will bottom out. But certainly these are the prices where I will look to add those names. While on the other hand, there are a lot of sectors which are screaming value, trading at mid-single digit to low single digit Ps. Metals, oil and gas, utilities, mid-cap construction, capital goods name. I would still tend to avoid those names purely because of two reasons. One, most of them are cyclical in nature, and B, a lot of them are commodities where the pricing power is low and prices are dependent on global forces. So at the moment, even despite their cheap valuations, I will tend to avoid them.
Okay. All right. That's nicely summed up. Well-rounded view. Thanks very much, Gautam, for joining in and giving us some color on how you're approaching the market at the moment. We need to take a very, very quick break. We'll come back with a close in just a few minutes.